Okay, so our webinar today will be on the Hong Kong market outlook in the second half of 2026, our strategy, recommended strategy and stock picks. Okay, this is the disclaimer I need to show just for a while. And then our content to be covered today I will show you the ranking of major global indexes, how the major global indexes perform in the first half, and Hong Kong in comparison to other benchmarks, China and Hong Kong market overview, China economic outlook, stock picks, and most importantly, because one of the bright spots in Hong Kong uh, so far this year is our IPO market. So today I'll spend more time on the IPO playbook, how to uh, make profits from the IPO market. Okay, this table shows the ranking of major global indexes by upside in the first half of 2026. You can see rank 1 to 8, most indexes related to AI. For instance, Kospi and the Philadelphia Semiconductor Index both up more than one time, 100% so far in the first half this year, followed by Star 50 in mainland China, and then Taiwan weighted led by TSMC was up nearly 60%, and Chinex also did well in the first half because of AI stocks in the mainland. Then the sixth position goes to Nikkei and Russell 2000 as Sunshine component. So Nasdaq, S&P, and Dow Jones, they rank in the average medium ranking. Okay, Hong Kong, very disappointing, was down 10.7% in the first half. So it was near uh, the end of the queue. It ranked 18 among the 20 benchmark indexes. And Hang Seng Tech Index was down nearly 19%. So Hong Kong apparently underperformed other markets in the first half 2026. Okay. In terms of Hang Seng Index, the drop, it was down 10.7% in first half 2026. It dropped from a peak of about 28,056 to a recent low around 22,518 points. So it dropped more than 5,000 points from the peak seen in early 2026. Hang Seng Tech Index dropped even more by 18.9% in the first half, from about 6,000 points to a recent low around 4,230 points. Okay, China Enterprise Index, the H-share index, that was down 15.2% in the first half to 6, from around close to 9,600 to 7,400, recent low of 7,400. But in the last 1 week since entering July, we noticed turnaround in the in Hang Seng as well as Hang Seng Tech as well as the H-share index. So we view this as a technical rebound after the sell-off in the last 2 months from May to June. So we view this as a technical rebound. So later I will share with you the resistance level that investors should take note of if this is just a technical rebound. Okay. But first of all, we need to identify the causes for Hong Kong's underperformance. And if these causes still exist, Hong Kong will continue to underperform other major stock markets. Okay, the first cause is structural mismatch in the global AI rally. So Hong Kong lack of hard. Okay. So Hong Kong, there's a lack of hardware and semiconductor plays. While markets in Taiwan, South Korea, Taiwan they have the TSMC. South Korea they have SK Hynix and Samsung, and the US search AMD, Nvidia surge on the back of hardware and chip maker frenzies. Whereas Hong Kong's tech index is structurally dominated by B2C internet platform stocks such as Alibaba, Tencent, and Meituan, and JD.com as well. Okay, and there's also affected by the fear that AI will disrupt software players, software manufacturers. Internet platform companies, the traditional heavyweights of the index, face steep corrections globally over concerns that legacy business models could succumb to AI disruption. So they do not stand to benefit from this AI rally, AI wave. Instead, they are feared to be disrupted or marginalized by the AI innovation. Okay, second cause is high correlation with mainland China's slower economic growth. The financial performance of Hong Kong listed mainland firms remains heavily tied to China's domestic economic recovery. So in the first half this year, muted consumer confidence, very lackluster, sluggish consumer spending in China, and also materials downturns directly penalize the index consumer-facing giants. Okay. The third cause is high interest rate and the Hong Kong dollar pegged to the US, with US federal fund rates and Hong Kong HIBOR remaining high. Investors can easily earn a low-risk 4.5% to 5% yield on cash, US dollar fixed deposit, or buy US treasuries. So for the more risk-averse investors, they may not prefer to be exposed too much to the Hong Kong stock market. Okay, high interest rate crushed the valuation of long-duration growth stocks. The B2C internet and technology heavyweights that dominate the Hang Seng Tech Index. That's why in the last half year, we saw the consistent decline in the internet giants such as Alibaba, Tencent, and Meituan. One of the culprit is high interest rate. Okay, high interest rates spike the interest expenses of highly leveraged companies, directly dragging down net corporate earnings. So among the highly leveraged companies in listed in Hong Kong, those they will suffer under the high interest rate environment. Large cap market anchors, particularly internet giants and the automotive supply chain, have seen major corporate earnings downgrades. These also have negative impact on the broad market. Okay. Fourth cause is increasingly concentrated trading into defensive high dividend yield stocks. Last time I remember we recommend this shield and growth and defensive strategy, the so-called dumbbell strategy. But with more funds going into defensive high yield stocks, these stocks act as a double-edged sword for the Hong Kong stock market. While it provides a vital stabilizing floor for the index, it at the same time starves growth sectors of liquidity. So it draws the liquidity from growth stocks. Okay, and the index, especially the Hang Seng Tech Index, is adversely affected by more fund flowing into defensive high yield stocks, which will not be reflected in the tech index, which is mainly a growth index. Okay, an index of growth stocks. Locks the market into a structural valuation trap and fundamentally alters the market's trading dynamics. So the PE multiples of dividend-paying growth stocks are compressed further as investors demand a high-risk premium to pass up on safe 7% yields. There are still quite many high-yield stocks yielding 7%. So investors will demand a high-risk premium when facing stocks that can return a 7% dividend yield. Okay, so this causes the PE multiples of non-dividend paying growth stocks to be suppressed further. Okay, as trading concentrated heavily in defensive stocks such as financials, energy, and telecommunications, index performance becomes coupled with the policy directives and regulatory changes governing mainland state-owned enterprises. They are more vulnerable to policy directives. For instance, the telecommunications, they're supposed to be quite their cash flow, very steady cash flow. They're supposed to be very defensive. But remember, early this year, the Chinese government decided to raise the VAT tax rate for telco operators from 6% to 9%. It's a 50% increase. Then the share price saw a sell-off because of this. And recently, state-owned banks are under investigation, followed by audit reports unveiling some irregular practices such as tax evasion and also unregulated lending. Tax evasion is reported under Bank of China, and then irregular loans, unregulated loans reported under ABC, Agricultural Bank of China. So these stocks, they are on the one hand very defensive, yet because of their state-owned enterprises nature, they are more vulnerable to policy directives and regulatory changes. Okay, the fifth cause is looming wave of expiration of IPO locked up shares. The Hong Kong market face massive supply side pressure in mid-2026 as record IPO lockup expires. This also pressurized the market because the fear of the disposal of those lockup shares. Over 255 billion Hong Kong dollars in shares tied to previous IPOs expire from the lockup restrictions in July this month. Just July alone, over 255 billion Hong Kong dollar in shares will see their lockup being expired, triggering widespread selling pressure. So if you are familiar with one of the stock, Minimax, its share price dropped from 1,330 Hong Kong dollars to the recent 330. So it's dropped more than $1,000 from the peak. Partly because it has risen too much before, and partly because of the concern about lockup shares going to expire. Okay, so the Hong Kong market now shows a highly polarized K-shaped performance. Actually, this K-shape is very frequently mentioned recently because it shows polarized performance. The one stroke goes up, the other stroke goes down. So it shows the polarized segmented economy and also segmented stock market. Okay, top sector gainers include AI hardware. There's still top sector gainers in the Hong Kong market, which we think in the second half they will continue to do well. So these are the sectors investors may pay more attention to. First of all, AI hardware, They are driven by the global AI infrastructure build-out. Companies related to the AI hardware supply chain surged. Semi and defensives, benefiting from localized substitution trends. Semiconductors such as SMIC and Hua Hong Semiconductor. They benefit from localized substitution trends and state-directed structural capital, frontline foundries, and advanced packaging layers surged. Okay, the two companies, okay, SMIC and Hua Hong Semiconductor. And state-owned high-yield defensive, traditional high-yield, high cash flow, large cap serve as a vital shield against macro headwinds. Despite the fact that I mentioned they may be vulnerable to policy directives, yet their dividend yield, the high yield, make them very defensive in the volatile market. Okay, major sector losers. These are sectors that investors should try to avoid: electric vehicles, EV, and automotive supply chain. You can see BYD's share price keep falling until recently after the release of the June sales report that the share price started to rebound. But our view is that the inherent adverse factors are still there, so it's just a technical rebound. Okay, key drag factors included an intense domestic price war and inventory saturation overhanging dealership networks, and rising overseas trade protectionist barriers capping export margins. Okay, so they need to go global, 走出去, 出海, go global. Yet outside China, they are facing more and more protectionist barriers, trade barriers. Okay, the other sector loser is consumer discretionary and high-end retail. E-commerce platforms and core domestic consumption face intensified margin competition and shifting consumer patterns. If you look at May renminbi new loans data, it shows that households in China or consumers prefer to save more or repay the debt rather than to spend more. So in view of the uncertain economic outlook, it shifts the consumer patterns. Okay, aviation and global transport. For much of the first half, domestic airlines and regional shippers face extreme headwind pressures from soaring international oil prices tied to escalating Middle East conflicts. But this trend started to ease since late June as oil prices started returning below $70. Okay. So China's economy, using this description to summarize the China's economic performance in the first half is strong supply, yet weak demand. Okay, China's economy expanded at a resilient 5% year-on-year pace in the first half of 2026, anchoring close to the upper end of Beijing's official full-year growth target of 4.5% to 5%. However, macroeconomic indicators reveal a distinct two-speed recovery. It's also a pattern, K-shaped, polarized economy, which is characterized by robust industrial output and surging high-tech exports, alongside stubbornly weak domestic demand. Okay. Key growth accelerators are namely high-tech industrial high-tech exports, the export outperformance, and also targeted policy backing. Industrial output expanded steadily, hitting 5% overall early in the year. In the first 5 months this year, industrial output expanded by more than 5%, growing faster than the overall GDP growth. Production was overwhelmingly driven by new quality productive forces, 新质生产力, including advanced manufacturing, EVs, AI hardware, and green technologies. External trade served as a vital growth engine. May exports surged to 376.8 billion US dollars, generating a massive monthly trade surplus of 105.4 billion US dollars. Global demand for Chinese clean energy and advanced engineering remains strong despite escalating international tariff threats. Okay, and targeted policy backing the People's Bank of China maintained a moderately supportive monetary stance. Credit injection shifted strategically away from the property market and directly toward industrial upgrades and equipment renewals. And in turn, this also helps export because more support to the industrial sector. So they are able to export more. Okay. There are persistent drags, however, headwinds. Muted consumer spending. Retail sales growth languished at just 2.4% in the first 5 months this year, and May posted negative growth of 0.6%, worse than the 0.2% drop expected. Domestic consumption remains weak as households opt to save rather than spend, influenced by a long-term deflationary mindset and the fading effects of earlier national trade-in subsidies. Okay, so it's diminishing margin. The effects are fading. Okay, the property slump. Fixed asset investment remain a notable negative weight. The real estate market crash and the subsequent deleveraging campaigns continue to suppress construction-led economic expansion. So among the three troikas, the so-called 三头马车, fixed asset investment and consumption are the key drags on the economic growth, with only industrial output led by exports, mainly driven by exports. Okay. Stubborn inflation indicators. While CPI picked up moderately to positive 1.2%, it reflects an acute supply-demand imbalance where factory production severely outpaces local consumer absorption. PPI increased more because of the surge in oil prices in the last few months. So the difference between China's PPI and CPI is close to 3 percentage points. So what does that mean? That means the factory gate prices are higher than the consumer prices. So which means profit margin of consumer products manufacturers are under tremendous pressure because they cannot pass on to consumers because of weak consumer spending. So this eats into the profit margin of a lot of consumer products manufacturer. So for the second half of 2026, we expect the economy stabilizing at a slower structural pace. We project a slight growth moderation for the remainder of the year, tracking a full year GDP expansion of roughly 4.5%, still in line with the official target of between 4.5% to 5%. The second half of 2026 will be defined by three critical themes: geopolitical and trade headwinds. They will not go away easily. Fiscal and monetary policy consolidation and transition to innovation driven output. These are the three critical themes that will guide the economy in the second half of 2026. For geopolitical and trade headwinds, the record high export volume seen in the first half this year were partially inflated by global buyers front-loading orders to beat incoming tariff deadlines. As trade restrictions from the US and EU tighten on Chinese EVs and solar infrastructure, export momentum is anticipated to ease in late second half. Fiscal and monetary policy consolidation, the People's Bank of China, is expected to pivot to a wait-and-see approach for the rest of 2026. Broad interest rate or reserve requirement ratio RR cuts are unlikely because now the US there's a high chance that the Fed may raise rates at least one time before the end of this year. So with US interest rate remaining high, or there's the tendency to raise interest rates, China is in a more difficult position to cut interest rate. Okay, Beijing remains firmly committed to long-term structural economic transformation rather than, like in the past, launching massive short-term debt-fueled stimulus. Okay. Transition to innovation-driven output, the domestic economy will continue transitioning from a real estate and infrastructure-dependent model to an automation and software model. While this means headline GDP numbers may appear flatter compared to previous decades, the underlying health of China's high-value supply chains will remain highly competitive. Okay, back to the Hang Seng Index. As I mentioned, this wave, we work out the Fibonacci resistance levels for the recent decline from 26,000, around 26,000. 88 to 22,518 is recent decline. If the Hang Seng Index rebounded by 23.6%, which is the initial minor rebound, the initial minor resistance will be around 23,538. Actually, it has already hit this level the last 2 days, yesterday and today. Okay, so the next resistance, Fibonacci resistance level, if the index will be able to rebound 38 to correct 38.2% of the drop, it will rise to 24,170, which is a key pivot zone. Okay, up till now, the Hang Seng Index is still below 24,000. Okay, so the if the index is able to rebound to correct 50% of the decline, the Hang Seng Index will rise to 24,681, which is psychological halfway of the total decline in the last 2 months since May. Okay, 61.8% ratio. The index will be able to rise to 21,191.47, which is also the so-called golden ratio. Okay, deep retracement will be 78.6% correction of the decline, implying the index will rebound to 28,823. So now we are somewhere here between this and this. Okay, so then in the second half, we may be looking at these two levels, or at best up to 25,000. The Hong Kong market will still be on a relatively weak stand. Okay, so the picking stocks become more important in a market that moved in a relatively weak market. Okay, Defensive stocks, we still prefer telecommunications because these state-owned giants offer a dominant market share, resilient cash flows from data consumption, and a corporate mandate to maximize shareholder returns. It's mandatory to pay because these state-owned companies, when they pay higher dividend, the government will also benefit by receiving more dividend payment from these state-owned enterprises. China Mobile features a low beta, 0.55, a robust net cash position, and a stable 7% to 8% dividend yield. The company's ongoing commitment to increasing its payout ratio provides strong price support during broad market sell-offs. Okay, so the share price actually rebounded quite strongly between April and June from around $75 to $85.53. Okay, but since mid-May, it was on the decline again. So when the share price corrected to the previous support level, around $75, we reckon that it would be a good entry level if investors like China Mobile. $75 to $76 would be a good entry point. Okay, the other defensive stock pick are traditional utilities. These stocks are low beta safe havens. They are highly insulated from economic cycles due to regulated returns and elastic demand for utility service such as electricity and gas. One of the stocks we like is CK Infrastructure, the Cheung Kong Infrastructure, stock code 1038. It is a globally diversified infrastructure play with regulated cash flows across the UK, Australia, and continental Europe. It boasts a spectacular 28-year track record of consecutive dividend growth, non-stop, 20 years in a row, an expected dividend yield between 5.4% and 5.8%, making it highly resilient against local macroeconomic headwinds. Okay, so the share price topped around $66 in between March and May, and now it corrected to below $60. You can see here it gets clear support from the 250-day moving average with the red line. Okay, now the 250-day moving average lies around $56. So if the share price dropped to close to $56, it would be a good entry level. If you look at a target 66, it's more than 10% return, $10, more than 10% expected return. For China Mobile, we recommend to buy at between $75 and $76 and target $85, the previous high. Okay, another defensive stock cash-rich and high payout retail. These companies benefit from robust balance sheets, zero debt, and strategic corporate ships that lock in high shareholder distributions. One example, one stock we pick is Sasa International Holdings. I think Singapore consumers may not be would be familiar with Sasa. Is expanding in Singapore and Malaysia, while after completely closing all its loss-making brick and mortar shops in mainland China, now is becomes a highly liquid retail turnaround play. Its net profit for the financial year ended March this year, net profit surged 160.5%, and backed by a net cash position and zero debt, the company declared a 100% dividend payout ratio for the full year with expected dividend yield between 6.5% to 7.2%. Okay. So the share price also reflects the turnaround. You can see the share price rose from around 60 Hong Kong 60 cents to $1, and now it's trading at around 93 cents. Okay, so any correction towards the three moving average, the 50-day and the 20-day primarily, which lie around 87 cents. 87 cents will be a good entry level. And then target is the $1 peak seen in early May. Again, there's more than 10% expected return if one manages to buy around 87 cents and sell around $1. Okay. Another defensive stock pick is Link REIT. Okay, 823. It boasts an attractive 6.8% dividend yield and remains a viable income play. Its occupancy remains exceptionally high at 97.8% in Hong Kong, proving that daily needs tenants such as foodstuffs and wet markets are keeping the malls filled. Its overseas assets are outperforming, with Singapore and Australia locking positive double-digit rental reversions of 12.3% and 16.5% growth in the financial year ended March this 2026. And then another expected catalyst would be the REIT Connect. Okay, it's the Connect scheme between mainland China and Hong Kong, whereby mainland investors can invest into Hong Kong stocks, Hong Kong ETFs. They now is already available, Stock Connect and ETF Connect. What is not yet available is REIT Connect. They're still working on it. Expected to be launched perhaps in the second half before the year end. So REIT Connect stands as the single most powerful structural catalyst for Link REIT, as onshore Chinese investors are starved for stable, high-yield, defensive income options amid the weak domestic property sector and volatile A-share stock markets. So they prefer something more stable and high yield. So Link REIT would have this appeal to them. Okay. The share price performed quite well in the first 5 months this year, rising from around $33 to close to about $40. So total gain, recording a more than 20% gain. Okay, now its share price corrected in the last 2 months, so we reckon that around $35, between $35-$36 is a good entry level, and our target would be the previous high $40. So again, there's expected more than 10% odd return if one manages to buy around 35 and 36 and sell at close to $40. Okay, closed stock picks. We recommend biotechnology this time because the biotechnology sector has faced severe macro pressures over the last 8 months and is currently experiencing a cyclical and structural turning point. Amid recent capital rebalancing in the broad market, the positive fundamental advantages of the pharmaceutical sector have become more prominent. So we noticed that profit taking in the AI sector and money looking for low valuation stocks beside the internet companies, the e-commerce platforms such as Tencent and Meituan. The biotechnology sector is also one sector that has potential for revaluation. The Hang Seng Biotech Index has gradually exceeded the bottom of 11,600 previous adjustment and is poised for comprehensive valuation recovery. Data shows that the total value of overseas business development (BD) deals for domestic innovative drugs from January to June this year exceeded $90 billion, with Q1 alone surpassing $60 billion, nearly half of the full year 2025 total. China has officially overtaken the United States to become the world's largest source country for innovative drug out licensing. A lot of MNC, multinational companies, they collaborate, they're seeking exclusive licensing rights from Chinese biotech companies to license out their innovative drug. Okay, the first half saw multiple blockbuster multi-billion-dollar deals, including CSPC Pharmaceutical Group's $18.5 billion collaboration with AstraZeneca, Hengrui Pharma's $15.2 billion agreement with BMS, and Innovent Biologics $10.5 billion strategic license with Pfizer. Average upfront payments in the first half surged to $184 million, up 59% year-on-year, with more than 15 deals exceeding $1 billion. The full year 2026 business development transaction value for Chinese innovative drugs is expected to break the $150 billion mark, leaving further upward valuation revision potential for core innovative drug companies. Okay, in terms of policy, policy support, China's National Medical Products Administration (NMPA) recently solicited public comments on the announcement on optimizing the review and approval of cell and gene therapy products. Is a draft for comments. The document supports clinically value-oriented R&D and innovation in cell and gene therapies and will include eligible cell and gene therapy products in the 30-day expedited review and approval channel for innovative drug clinical trials. So they're going to speed up the review process for eligible cell and gene therapy products. In the second half of 2026, the fundamentals of China's innovative drug industry are expected to improve steadily. The core drivers include enhanced R&D quality, global value validation, and improved profitability. Looking ahead to the second half of the year and beyond, major international academic conferences such as the WCLC conference, ESMO, ACR, and ASH will be held successively. These conferences serve as incubators for multinational corporations seeking cross-border licensing deals, either in-licensing or out-licensing, to introduce new drugs. And China's biotech companies benefit from the increase in these MNCs, multinational corporations, looking for in-licensing to get the license of innovative drugs from Chinese companies. So it's in-licensing. Okay, the investment objective, because there are a lot of biotech companies, investors may not be too familiar with the fundamentals, okay, or the business model, business nature, and business model. So an easier option is ETF, the China AMC Hang Seng Biotech ETF, stock code 3069. The investment objective of this ETF is to provide investment results that, before fees and expenses, closely correspond to the performance of the Hang Seng Biotech Index. The Hang Seng Biotech Index tracks the performance of the 30 largest biotechnology and healthcare companies listed on the Hong Kong Stock Exchange. They are eligible for trading via the southbound Stock Connect scheme. Industry scope includes market leaders classified under pharmaceuticals, biotechnology, medical distribution, or medical devices. Chapter 18A coverage uniquely incorporates pre-revenue biotech firms. So the Hong Kong exchange allows companies with no revenue to get listed under Chapter 18A. Biotech firms that have no revenue yet, they can also be listed on the Hong Kong stock market under Chapter 18A coverage. Okay. Weight distribution companies specializing in core battery and pharmaceuticals dominate the index, making up over 90% of its aggregate weight. Okay, the top 10 holdings of this ETF include Innovent Biologics, B1 Medicines, WuXi Biologics, WuXi Eptech, Acasol, China Pharmaceutical Group, Sino Biopharmaceutical, Hansoh Pharmaceutical Group, 3S Bio, and Sichuan Kelong Biotech Biopharma. So the share price has corrected more than $6. Has dropped $6.5 from a high of $18.57 seen in early October last year, and it bottomed out around below $12. Now it started to rebound. I think it outperformed the Hang Seng Index as it has managed to rise above the 100-day moving average. The next resistance level will be the 250-day moving average, around $15.40. Okay, $15.40. And of course, above the 250-day average, the next target will be around $16.50. Okay. Now we come to Hong Kong IPO playbook, because overall performance of the Hong Kong market, I think, admittedly, is quite disappointing in the first half this year. As I mentioned, all the three major indexes, Hang Seng, H-share index, and the Hang Seng Tech Index, dropped more than 10% in the first half. Okay, so the only bright spot so far is our IPO market. And how to play the IPO market, we have some suggested strategies. And you may ask whether Singaporeans can participate in Hong Kong IPO market. I think the answer is yes. You may participate through PSPL, Phillip Securities Singapore. You can apply through Phillip Security Singapore and through Phillip Hong Kong for those IPOs going to be listed on the Hong Kong Stock Exchange. So a recap of the Hong Kong IPO market performance so far in the first half this year. Total funds raised was 210 billion. Sorry, I've left out a very important B. The letter B is 210 billion Hong Kong dollars raised in the first half, representing a 92% year-on-year surge compared to the first half last year. Deal volume also increased by 98% from the same period last year, with 87 new listings so far in the first half this year. So Hong Kong jumped to the second place globally. If not because of SpaceX historic listing, Hong Kong will keep the #1 position. But however, SpaceX listing pushed Hong Kong to #2. We narrowly trail the tech-heavy Nasdaq, which only held the crown due to SpaceX historic listing. Sector dominance. We notice in IT and telecommunications spearheaded the main board, accounting for 48% of the IPO listings. So in the first half this year, followed by industrials and materials, accounting for 21% of listings, and healthcare and pharmaceuticals, accounting for 18%. Okay, key drivers will be regulatory tailwinds, fuel the record wave of 24A plus H dual listing. China, the CSRC, they are very supportive of. They try to encourage more companies that are listed on the A-share market to be duly listed in Hong Kong, A plus H dual listings. So it will become more flexible for these companies, these Chinese companies, to raise funds either on the domestic stock market or from Hong Kong, from the Hong Kong market. And there are 13 specialist technology listing under Chapter 18C. So 18A cater for companies with no revenue, the biotech companies with no revenue. 18C are cater for those high-tech companies, high specialized high-tech companies with no revenue. They can still apply for listing under Chapter 18C. So these 24A plus H dual listings and 13 specialist technology listings contribute over 70% of total first half funds raised. Okay. Second half outlook, estimated fundraising target for the full year will be 380 billion Hong Kong dollars. Active pipeline, the Hong Kong Exchange disclosed that there are more than 500, close to 600 candidates queuing, applying for listing. So that will be sufficient for around 150, around 150 listing every year. This queue will be sufficient for 3 to 4 years application, IPO application or IPO listing for the next 3 to 4 years. So the Hong Kong EX will also stand to benefit from the IPO frenzies, IPO key growth catalyst themes. There are three. The AI and semiconductor clusters following the successful Chapter 18C fast-track listings of AI giants like Minimax and Knowledge Agnes, the Zhipu. Hong Kong's pipeline is heavily populated by deep tech, new materials, and advanced robotics firms. So investors can expect more of companies of this type to be listed in future. Okay. Securities law overhaul. The Hong Kong government is actively amending local securities laws later this year. This reform simplifies SFC objection procedures. In the past, the vetting by SFC as well as the stock exchange takes very long for companies to get the approval for listing in Hong Kong. So in the past, some companies, they go to Singapore. They choose Singapore because of a shorter approval time. But now Hong Kong SFC, they are trying to shorten the vetting procedures and relaxes post-listing rules to aggressively court global REITs and international conglomerates to be listed in Hong Kong. Southbound liquidity backstop, immediate inclusion of new listings into the Hang Seng Composite Index. Once the newly listed companies is being included into the Hang Seng Composite Index, it will be eligible for mainland investors' investment through the Stock Connect. So there is this fast track for companies to get access to southbound liquidity, southbound funds. This grants issuers instant access to mainland China's retail and institutional capital pools. Okay, so these are the three key growth catalysts that support the Hong Kong IPO market. Okay, sorry, there's something, I need to change my big weight because I have updated my PowerPoint. This is not updated, so I need to update it. I need to change the, yeah, should be this one. Sorry, sorry for the interruption. Because before the IPO stacking playbook, can you see my share screen? The new share screen. Go to the page. Shows the performance of the IPO, because most importantly is their share price performance on the first on the listing day that attracts investors to this is the key performance metrics of Hong Kong IPOs in the first half this year. Average grey market price gain. Now, in Hong Kong, there are grey markets trading IPO just one day before the official listing. And Phillip Securities Hong Kong is the first broker in Hong Kong that offer SFC authorized grey market trading platform known as Phillip Mart. Okay, now there are around 3 to 4 grey market trading platforms that offer grey market trading of newly listed shares one day before the official listing. So average grey market, we track the performance. Average grey market price gain the day before the listing was 68.2% average price gain, with 74 out of 84 tracking stocks trading up. There are, however, some stocks that drop below the listing price, but percentage-wise, it's only less than 10%, 74 versus 84, slightly more than 10% now. But the price gain is quite impressive, 68.2% average grey market price gain. And comes to the listing day, at the debut, average listing day price gain is 61%. Win rate, that means if investors choose to sell on the grey market one day before the listing, they may make more. I mean, by average number, they may make more compared to selling on the first listing day. Okay, the win rate, approximately 82% of IPOs successfully closed above their offer price on day one. Okay, retail subscription boom. The average retail subscription multiplier surged to over 2,620 times oversubscribed. Nearly compared to the previous year, this oversubscription multiple is nearly 3.8 times higher. So the higher the oversubscription multiple, the tendency for the share price to rise more is higher. Higher tendency for the share price to rise more on either the grey market or on the first listing day. Okay, so because of this, before we go to the stacking strategy, I'll show you the star gainers and the heavy losers, what to avoid and what to choose from going forward. Okay, CG Technology 1879 recorded a staggering 383.8 times gain, first day gain. Okay, so for those investors who are allotted even one lot only, they make more than 10,000 Hong Kong dollars easily on the first day, making it the biggest debut jump in 8 years. Okay, another stock, 2513, while rising a moderate 13% on day one, it became the top wealth creator of first half 2026, skyrocketing over 1,710%, 17 times by late June to cross the 1 trillion Hong Kong dollar market cap threshold. Okay, Minimax surged over 5 times within months of its public debut. Okay, these are the stock gainers in the first half of 2026. Whereas heavy losers, HJ Science, Stockco 6132, plunged 56% on day one. Tong Shifu 664 closed down more than 40% on its debut, worsening to a cumulative drop of 77% drop by the end of first half. But these are the rare case. So how to pick the gainers and avoid the losers? We come to this IPO stacking playbook, stacking strategy. What is known by stacking? Stacking refers to an investor who subscribes to an IPO with the sole intention of selling the shares immediately on the first day of trading for a quick profit. It's called an IPO stack. So IPO stacking playbook, there are three items to take note of, namely core selection metrics, leverage and trading strategies, and key risk constraints, what to avoid. Okay, for core selective metrics, oversubscription multiple is one reference point. So look for public tranches oversubscribed by at least 15 times. This triggers the mandatory clawback mechanism. In Hong Kong IPOs, the initial share allocation is usually split between retail and institution. 10% goes to retail public tranche and 90% goes to institutional tranche. So when the oversubscription is more than a certain multiple, say for instance 15 times, then the clawback it will trigger the clawback mechanism, meaning that a certain quantity of shares will be taken from the institutional tranche to the retail public tranche. So raising the possibility of allotment, getting allotted for retail investors. It will shift shares from the institutional tranche to the retail public, which signifies high, on the one hand, it signifies high market momentum. So these are hot IPOs. Usually hot IPOs will tend to rise more on the gray market or on the first listing day. When these institutions cannot, the underlying mechanism is when these institutions, because the clawback, shares are shifted from the institutional tranche to the retail public tranche. So institutions may not be able to get their target portfolio allocations during the IPO stage. They are forced to go into the open market on day one, the first listing day, to buy shares. So this will help push up the share price very sharply and drastically on the first listing day. Additionally, a massive oversubscription multiple creates a sense of FOMO, fear of missing out, among retail traders. Okay, the other metrics for core selection, IPO selection, is to look at the cornerstone investor roster. Ensure reputable sovereign wealth funds such as Singapore Government Investment Company, Temasek, or top-tier asset managers such as BlackRock, Fidelity have locked up capital. They committed to the IPO. a high cornerstone ratio, for instance, more than 50% of the total offering, will drastically reduce downside risk on day one due to the mandatory 6-month lockup. So these are the two metrics investors may refer to: the oversubscription multiple, which is quite often reported in the press, in the papers, and also Phillip Securities Hong Kong will provide our in-house margin ratio, a margin book data as a indicator of the response of the retail response to certain IPO. When the margin easily we have margin book of more than 10 billion Hong Kong dollars for hot IPO. Our biggest one, I think, is close to 80 billion. That means we lend out 80 billion Hong Kong dollars to investors applying for IPO, subscribing IPOs. Okay. The third core selection metrics is sponsor track record. Okay, so investors are advised to check the historical first day performance of the lead underwriting banks or sponsors. Certain tier 1 sponsors have a reputation for pricing IPOs conservatively to ensure a first day pop, because the pricing of the listing price is negotiated between the issuer, that is the listed company, and the sponsors. The sponsor have a bigger say on the listing price. So it is rumored that certain tier 1 sponsors will try to suppress the reduce the listing price so as to ensure a first day pop. The share price will go up a lot on the first day. Okay. So investors, after you choose using the 3 core selection metrics to pick IPOs, then the other strategy to make use of to deploy is leverage and trading strategies. First is margin financing, because the allotment ratio is very low, sometimes below less than 1%. So you have to leverage to increase the application amount to so as to get more allotment. This involves borrowing funds from a broker to boost your subscription size. In Hong Kong, brokers regularly offer 90% margin, so you can just come up with 10%. Say, for instance, if you apply for a 1 million Hong Kong dollar IPO subscription, you are only required to to provide 10%, 100,000 Hong Kong dollars as initial margin, as the 10% margin required by the SFC. Okay, and you may ask, the interest rate for the 90% would be maybe very high. It will result in the finance cost to be borne by investors. But let me tell you, now is more increasingly popular in Hong Kong that no interest rate, zero interest is being charged on this 90% margin. Okay, take Phillip Securities Hong Kong as an example. We don't charge any interest for the 90% financing our clients borrow from us, from Phillip Securities. Okay, even if investors don't have the cash, don't have the 10% cash, if they have shares collateral with the company, we can lend even the 10% requirement, the 10% margin requirement to the investors. You don't have the 10% cash. The company can lend the 10%. For this 10% margin financing, interest will be charged, not for the 90%. Okay, and strategic tip is only use high margin on high conviction tech or AI plays where the probability of a first day surge outweighs the margin interest cost, the 10%. If you need to borrow the 10%, so you have to investors have to work out their sums to calculate the margin interest cost. Gray market trading, investors are advised to make use of gray market trading. This is an over-the-counter market provided by retail brokers such as PhillipCapital Hong Kong, held on T-1 day, the day before the listing day. It will start from 4:30 to 6:30 the afternoon, right before the official listing. And these gray market platforms, OTC counters, are all regulated and authorized by the SFC. So no need to worry about the counterparty risk, okay, or the settlement risk. Strategic tip is, if the gray market price surges heavily, consider selling 50% of your allotment in the gray market to lock in profits early and wait for the next day to consider whether to hold or to sell the remaining 50% when the share is formally listed on the exchange. Okay. Key risk constraints, what to avoid. Dual primary, secondary listings. There are more and more companies that are duly listed, either in the US and Hong Kong, or in China and on mainland China and in Hong Kong. Their stock price upside is already anchored by the home market, leading to a very quiet, more often a quieter, low volatility first day, because there's a cap on a ceiling on the top, on the upside, by the share price listed in the other exchange. Okay, the T+1 settlement cycle. Now, the Hong Kong EX, they keep on enhancing the IPO arrangement. So they launched this so-called FINI platform. Under the current Hong Kong EX FINI system, the gap between pricing and trading is reduced to just T+1. Like today, when the certain company is listed today, the pricing will be fixed the day before, that is yesterday. So this means market sentiment changes rapidly. Bad macro news overnight can weaken an IPO's momentum instantly before trading starts. There's still the risk the investors need to be aware of. But this is an enhancement already. In the past, the gap between pricing and trading usually takes 3 to 4 days. So the risk, overnight risk, in the past, investors have to bear 3 or 4 day overnight risk if there are any bad development, bad macro news that happen during the gap. But now it's shortened to 1 day, so it's quite very much reduced. Okay, so for IPO, if it is difficult to apply, there is this ETF, the only IPO ETF in Hong Kong. Is managed by Phillip Asset Management Hong Kong, the asset management arm of Phillip Securities, PhillipCapital Hong Kong. This Hong Kong newly listed equities ETF, the stock code is 2835. It's screened for high quality newly listed stocks. The index constituent screening process imposes strict, is a passively managed ETF, tracking the selective Hong Kong newly listed equities ETF, and the index will screen for high quality newly listed stocks, and also the maximum number of constituents is 50 stocks and minimum is 35. So there is sufficient diversification. Sometimes IPO, some investors are mindful of the the risk, because these are newly listed companies, and unlike companies that have been listed, they have a long listing history or long operating history, the risk may be higher. So to diversify, for risk diversification, this ETF will provide the risk diversification, whereby investors can purchase a basket of multiple new stocks at a lower cost. The current price is around $10, and the board lot is 100 shares per board lot. So the so-called entry price, 入场费, the entry ticket price is just $1,000, 100 shares times $10. Okay. Mitigate losses due to misjudging the market or individual stocks. So there's this advantage of diversification. Some of the newly listed stocks exhibit significant volatility, like Minimax. It can go up to from $220 to $1,330, and from $1,330 drop to current around $330. So this volatility is quite scary. So by investing an ETF, this newly IPO ETF can effectively diversify the risk associated with individual stocks. Okay. The fund or the ETF aims to fully replicate the selective customized Hong Kong newly listed equities index, which is designed to track the performance of securities recently listed through initial public offerings, IPOs, or newly listed on the main board of the Hong Kong Stock Exchange based on certain conditions. Some stocks, they don't go through, they're listed not through IPOs, through introductory, through physical delivery by a parent company spinning off a subsidiary, and they distribute physical distribution to their shareholders. So not all new listings are through IPOs, but those introductory by introduction are quite rare. The index will be rebalanced quarterly, including securities that conducted IPOs or were newly listed within the past 756 trading days. That mean, or in other words, in the last 3 years, are considered newly listed companies. The index will select the top 50 securities by free float market capitalization. Additionally, subject to liquidity and market capitalization standards, the index will include eligible newly listed securities after a monthly review. So there's this fast track to include new IPOs, newly listed companies every month in the same months that they are being listed. Okay, so there's this faster arrangement. Top 10 holdings at the moment are CATL, this battery, the largest iron battery manufacturer in China as well as in the world. BREN Technology, AI software, J&T Global Express. I think they are also present in Singapore, Indonesia. They are very they originated from Indonesia. J&T Global Express, Media Group, manufacturer of Meidi home appliances, but now they are also in moving in to the area of robotics. Talking about robotics, one of the constituent top 10 holdings include Horizon Robotics and Minimax, InnoScience, Suzhou Technology. This is semiconductor equipment and testing. Victory Giant Technology, 2476, electrical components equipment, and Giga Device, semiconductor. So increasingly we see more AI, semiconductor type of companies, as well as biotech as well. So these, unlike other thematic ETFs, they have only one theme. Like EV or biotech, they only invest in biotech, EVs or robotics. This Phillip Hong Kong newly listed ETFs, it has no fixed or single investment theme. It will be very diversified. It depends on the kind of companies they are being listed in the last 3 years. So in the last 3 years, there are more AI companies and biotech companies being listed. So the ETF will the constituents, you'll see more companies of this kind, like AI, semiconductor, and biotech. If in going forward, there are more. Just take example, more property companies being listed in Hong Kong, or more. Yeah. So the constituent, the makeup of the composition of the ETF will change accordingly, and this is the flexibility of the ETF compared to fixed theme ETFs. Once the like EV ETF, if the industry goes out of favor or is not performing, then the ETF doesn't will not also perform as well. Okay, if you wish to, I am always asked by Singapore foreign investors to get more, where they can get more market information on the Hong Kong stock market. So you are recommended to subscribe to our Phillip Securities Hong Kong YouTube channel. You can just scan this QR code, and then you every morning before 10 a.m. we'll upload on YouTube our daily market opening bell video in 3 different languages: English, Mandarin, and Cantonese. So if you are keen to learn Cantonese, you're welcome to watch and listen to our Cantonese version of market opening bell. Okay, so you may scan this QR code. Okay. Besides this, we also have launched a WhatsApp group on Hong Kong and US stock. You will provide our daily stock pick and also analysis of individual company analysis. So investors who join this WhatsApp group will have the first look at our stock picks, namely my stock selection, the next trading day. You'll get it 1 day before we publish the stock pick the next trading day. And also we'll publish in this WhatsApp group our weekly exclusive Hong Kong and US stock insights. Okay, key stock dynamics and data compilations reserved strictly for group members. It's free. You can scan this QR code and join the WhatsApp group and receive the notification. So these are some of, but this the language medium for the time being is only Chinese. So if you can read Chinese, you're welcome to join the WhatsApp group. This one, some example of our analysis. This one is on Tencent. Disposing of Kuaishou recently, just yesterday, last night, how we analyze Tencent's disposal of Kuaishou. And then this one is weekly market commentary and technical analysis of Hang Seng Index. This one is our daily stock pick. Oh, just now, growth stock pick, I missed out one. That is Tencent. Okay. Besides the biotechnology ETF, which is the biotechnology ETF is this one. China AMC Hang Seng Biotech ETF 3069. The investment objective of the sub-fund is to provide investment results that, before fees and expenses, closely correspond to the performance of the Hang Seng Biotech Index. So the Hang Seng Biotech Index tracks the performance of the 30 largest biotechnology and healthcare companies listed on the Hong Kong Stock Exchange that are eligible for trading via the Southbound Stock Connect scheme. Industry scope is quite wide, cover market leaders, classify under pharmaceuticals, biotechnology, medical distribution, and medical devices. Chapter 18A companies are also covered. Uniquely incorporates pre-revenue biotech firms listed under Chapter 18A of the Hong Kong EX listing rules. And weight distribution, companies specializing in core biotechnology and pharmaceuticals dominate the index, making up over 90% of its aggregate weight. Okay, China AMC. These are the top 10 holdings. Include Innovent Biologics, WuXi Biologics, WuXi AppTec, Akeso, China Pharmaceutical Group, Sino Biopharmaceutical, etc., etc. So the share price corrected from 18.57 to $12 and recently rebounded to about $14. So we reckon that $13 will be a good entry level for this biotech ETF, $13. Okay, and the target we may not be so aggressive by looking at targeting $18.5 seen in October last year. A more conservative target would be $17. So recommended entry level is 13, 17. So the expected return is $4 is expected 30% return. Okay, the other growth topics is Tencent. Now recovering, we expect revaluation after the recent drop over the last 6 months. Okay, some of the bright spots are Tencent is monetizing through its WeChat AI advertising efficiency with the upgrade to its Hunyuan 3.0 preview model. Tencent has automated ad targeting and generative marketing creative loops. This has driven solid double-digit growth in its fintech and marketing services segments. So it's using AI to enhance its advertising efficiency. The next gen agentic play, rather than betting on standalone applications, Tencent is deploying its proprietary OpenClaw AI agents directly inside WeChat's 1.4 billion user base. So it will be able to leverage structural, non-replicable user data to monetize enterprise cloud workflows. The other point to take note is Tencent is reshaping its investment playbook. As showcased just as I mentioned, the recent 12 billion Hong Kong dollar secondary market block trade itself disposed of Kuaishou shares is holding. Tencent is freeing up vital capital, 12 billion Hong Kong dollars, to fund its aggressive share buyback mandates and its massive 36 billion yuan to 26 AI expansion budget. It's highly likely that Tencent will also make use of the 12 billion Hong Kong dollar sales proceed from the disposal of Kuaishou shares to flip into Kuaishou's newly carved out subsidiary, the Kling AI, Keling AI, which Kuaishou plans to get listed before the end of this year. So now it's participating in the fundraising round, the $3 billion fundraising round. After this fundraising round, Kling AI will be valued at $18 billion. whereas Kuaishou, the market cap is only 23 billion US dollars. Kling AI, once listed, it will be more, but it's only now after this fundraising round, the valuation rises to 18 billion US dollars. By buying directly into Kling AI at a structural discount valuation, Tencent captures the explosive ARR growth of China's leading video generative engine without enduring the structural package of Kuaishou's declining legacy live streaming division. So it's reshuffling its investment from mature the targets such as Kuaishou is being mature to unicorns, fast growing companies such as the Kling AI. Still Kuaishou within the Kuaishou family, yet they are Tencent is reshuffling its investment playbook, and that will we expect handsome return for Tencent after the listing of Kling AI. Okay, you can see the share price dropped from 633 about $600 to $411. Now starts to rebound, and I think it's a good, a very bullish signal that it manages. This is today's price chart, so it rises above the blue line. The blue line is the 50-day moving average. In the past, for the last 6 months, every time its rebound is kept by the 50-day moving average. Every time it fails to surpass the 50-day moving average. Only this time round, it managed to break through the resistance of the 50-day moving average. So it is expected to test the 100-day moving average around $485, and we expect its share price to be able to rise to the revaluation will bring its share price to about $500 or between $500 and $510. So good entry level would be around $460. And if it manages to rise to 500 or 510, the expected return will be around 10% or slightly more than 10%, which is the interim target set by us. So this is what I have left out just now when I talk about growth stock picks. Okay, so now I end my presentation. You can start the Q&A. Why price activity since Samsung outburst? What to do as investor and trader? Okay, we will because it's difficult to give price recommendation on buy-in price target because it's volatility is so high. Daily volatility can easily exceed 10%, sometimes 20%. It can drop more than 20%. So one advice is to use technical analysis, use the 10-day moving average as a reference point. When the share price corrects towards the 10-day moving average, and if you want to buy either Hynix or Samsung, the 10-day moving average would be a good reference point, a saver. At least it's not very far away from the last 10-day average price. This is one gauge that you are buying at a more reasonable and acceptable price. Okay, so I think still every buy on dip will be our recommendation because the DRAM and also the NAND, Samsung announced its second quarter financial results this morning. both turnover, revenue, and operating profit exceed market expectation, better than higher than market expectation, benefiting from higher DRAM prices and NAND prices. Okay, and the capacity is already taken up by its major key clients until 2027. So it's expected the shortage of DRAM and NAND shortage is expected to last until the end or the second half of 2027. So whenever there's a dip, buy on dips lah, but don't 不要高追, don't chase, but only buy on dips. And the 10-day moving average is a good reference point for good entry reference point. Okay. Kenneth said he owned Baba, JD, Tencent, how to read, manage with the Chinese government recent regulatory tightening and US placing them on blacklist. If price dip, are these buy on dips opportunities? Your TPs on this target on these names. Okay. Maybe I can share the if I okay. Okay. Among the Baba, JD, Tencent, just now we only picked Tencent because its nets is not is more insulated to the intense competition among e-commerce players such as Baba and JD. So Baba and JD regulatory tightening aside, the US placing them on blacklist, we don't expect much impact on the because the currently the blacklist is with US military. If they are not doing business with the US Army, US military, they won't be affected unless the blacklist expands to other areas, such as the state US State Council also include them on the blacklist. But at the moment, it's only the military, so the impact will be quite minimized. We prefer Tencent because of the reasons we quoted just now, and target price for Tencent just now we mentioned is $510. Okay. Can you give your latest view on JD.com and JD Logistics, still investable? As I mentioned just now, the e-commerce, because the consumer spending of the muted sluggish consumer spending, it also affects the e-commerce. I'm not sure if you have read the news about the latest June 18 the 618那个festival it was the most gloomiest 618 festival in the last 16 years since the history of this festival. So this is attributable to the sluggish consumer spending in China, which we expect will continue at least for this year into the first half of next year. So JD, Amazon, Alibaba will be under pressure, will continue to be under pressure. And they have, for Alibaba, JD may be better because the AI capex is less compared to Alibaba. Alibaba's AI capex will be even more because it's competing also on the AI cloud in the AI cloud arena. So between Alibaba and JD, if you ask me which is better, I would say JD. But the overall sector, the e-commerce sector, we are still we have reservation. We are not too upbeat on this sector because of the sluggish consumer spending environment in China. Outlook for 资金 mining. Okay, 资金 mining we expect is only a technical rebound. Gold price, because of the hawkish Fed, especially Kevin Walsh, is seen to be more hawkish than Powell. So gold price will be under pressure. So actually, recently gold price dropped below, very briefly below $4,000, pressurized by the high inflation as well as high interest rate remaining high in the US. So that is negative to gold price. So we expect this to continue at least. So there's still, I mean, in the last dot plot, 9 FOMC officials opt for at least one rate hike before the end of this year. So rising interest rate is not favorable to gold prices. And if gold prices are under pressure, 资金 mining will be also pressurized. So we only expect the price to rebound. Maybe I can share the price, the target and the resistance level. 资金 2899. Okay. Wait, 2899. Sorry, excuse me. I'm retrieving the chart. My chart doesn't work very well here. Maybe later. Okay. Helen. Now comes to Helen. What's your view on insurance company like AIA and Ping An? We like China Life better among these two. Okay. So in the first half, the new business value, NBV, grow at double digit, both under Ping An and China Life. But on a technical analysis point of view, China Life performs better than Ping An. Maybe Ping An because it's more diversified. You have banks, securities firm, and China Life is more a pure life insurance play. So people may prefer China Life to Ping An because of its single exposure to life insurance. And then both companies will also benefit from a more resilient A-share performance in the first half. The Shanghai Composite rose by how much? Let me see. So we kept the performance of the Shanghai and the Sunshine Index in the first half. Yeah, Shanghai, not just now I mentioned Hang Seng was down more than 10%. A-share, Shanghai was up 3.2%. Shenzhen was up 19.8%. The Chinex was up 35.6%, and the Star 50 up 64.3%. So the investment return recorded by China Life and not only China Life lah, but all the life insurance company in the first half will benefit from more resilient stock market. And also the low interest rate will lead a lot of savers, the depositors in bank depositors to shift their safe deposits into some investment linked insurance products that will also benefit, help the growth of new business value. Okay, AIA, not too sure because you may heard about the news that the Chinese government is cracking down on money on fund flow outside China going to Hong Kong, either to buy shares or to buy insurance. So AIA and also the share price recently got a hit, a blow, because of the concern about the crackdown. So we'll prefer for insurance players. Our topic is China Life. If you ask me to pick. Could you please share with us your view on Bank of China, Beijing Jingneng Clean Energy, and China Tower? Okay, Bank of China, the yield is because the share price outperformed the Hang Seng, the index, so the yield becomes less attractive. In the past, all the four state-owned banks yielding more around 6% dividend yield. At recent highs, the dividend yield drops to below 5% to 4% or for around 4 something percent. But recently, because of the correction, the yield improves to around 5.2%. So we expect you look at the yield. I think for Chinese banks, when the overall view is okay, we think so. The share price just fluctuate ups and downs, and it will affect the yield, the dividend yield investors are going to receive from the investment. So look for buying opportunity when the yield rises to close to 5.5% or above 5.5%. So it's a factor of the share price. When the share price drops more, the dividend yield will be enhanced, will go up. So we're looking at a benchmark of 5.5% for the four state-owned banks. Okay, but Bank of China, the recent finding by the National Audit Department about the tax evasion may have some negative bearing on the stock price. But the dividend yield, the 5%, above 5% dividend yield should lend support to the share price. Jingneng Clean Energy, it's okay because I think the yield as well as the share performance overall is so far over the years okay. Now I get the share price for Jingneng Green Energy. Oh, yes, dropped quite a lot recently from a recent high of $2.30 to at the moment is around $1.90. So we expect resistance. It's still in a rebound phase. Okay, resistance is expected around the 50-day moving average, which lies at around $1.95. So between $1.95 and $2, there will be stiff resistance. As for Zhijing, Zhijing just now 2899. we are also expecting the share price to be rebounding. Is just a technical rebound. The resistance, like Jingnang, is also will lies around the 50-day moving average, which is around $33, about 10% upside from the current $30. Resistance is expected around $33, where the 50-day moving average lies. As for China Life 2628, there will be resistance around the double top seen in May and June, around $31. But if it manages to break through the $31 resistance level, the next target would be $32.50. Okay, for China Life. China Tower 788. China Tower, because now China Unicom and China Telecom, they are joining force to reduce the renting of towers from China Tower. So this will affect the two companies. They share. I would say they share towers together to reduce the cost, the expenses on the rental expenditure on towers. Okay, telecom towers. So China Telecom will prefer. Actually, the PE, the valuation is still high compared to China Mobile. We prefer China Mobile to China Telecom. And also the dividend yield. Let me see the dividend yield. Dividend yield seems China Mobile is more attractive compared to China Tower. Yeah. China Tower, the current PE is trading on 11.7 times historical PE. The yield is 5.8%, whereas China Mobile, now remember the PE is 11.7 times and the yield is 5.8%. China Mobile, China Mobile is actually the major shareholder of China Tower, and also the key customer of China Tower. China Mobile is trading on historical P of 10.5 times, and the yield is 6.8%. So between China Tower and China Telecom, China Mobile, I think a better choice is China Mobile. Okay. Why are EV stocks doing badly? Because of the price competition, the evolution, nature, oversupply. Now, two date number for you to take consideration to as a reference point. China's car ownership has risen to around 350 million out of the 1.4 billion. So it's becoming quite close to the saturation. It's known as it's become a exist 全量市场，就是那个 additional growth will be very minimal because the car ownership in China has reached 350 million. So the future growth will come from existing car owners replacing the old cars. The first time purchase of ownership of cars will be very minimal going forward because the car ownership has risen to 350 million. And then EV percentage compared to traditional oil fuel car has risen to above 60%. So in the past, why EV grows so fast is because the penetration rate is very low. Now the penetration rate has has exceeded 60%. So there's the room for further growth will be rather limited, and the car ownership has also grown to substantial size. Now, only when existing car owners replace their existing car, there will be new purchase. So this is the situation in China. Have you observed a significant influx of foreign investment from the Middle East into the Hong Kong market, particularly with the property sector following the recent tensions in the Middle East? Not really. Stock market maybe, but property sector, I think, still is supported by mainland southbound funds. Okay, so there are always reports in the news that those are cake buyer, cake 西饼in Chinese is 西饼客，就是他们买西饼买那个cakes 的时候，你不是买一个not you only not buy one, but you buy half a dozen cakes or a dozen cakes. So mainland buyers they when they buy Hong Kong property, they snatch 6 units or 12 units. So if you ask me whether I observe any significant influx of Middle East funds into our property market, I think not reported as long as far as I am aware. It's not widely reported, but still mainland Chinese. But we are also keeping and watching closely how this crackdown on cross-border fund flow will affect the Hong Kong property market. So this is one thing we are watching closely, and also they may affect the share price performance of property developers in Hong Kong, such as Sun Hung Kai, Cheung Kong, and Henderson Land. How this crackdown will affect. It may take 1-2 months to see the impact, whether there's a significant impact on the property market. Okay, 4 more minutes. In your opinion, Alibaba was recently fined by $600 million for illegal sale of medicine and other products in the US. What's the impact on its earnings and cash position? Oh, last year, Alibaba, let me check. I think the impact is quite insignificant. Last year net profit. Wait a bit. Last year, Alibaba reported net profit of 129.4 billion yuan, equivalent to 17.8 billion US dollars. So 600 million is quite minimal. Okay, to answer your question. Okay, cash position. Let me see his. Ali, um, uh, Alibaba, wait, do you see the recent news flow of Chinese government clamping down on cross-border capital flows as an important factor that contributed to this only happened in June. So, but the underperformance started since January this year. So I don't think the underperformance is attributable to the crackdown. But admittedly, I will accept that this crackdown now. But the turnover since this clampdown happened in June, the daily turnover in Hong Kong stock market was not actually still maintained about 300 billion Hong Kong dollars, because for investors who are keen to buy Hong Kong shares, they still have another avenue, that is the Stock Connect. They can buy through the Stock Connect. So like yesterday, the net inflow from mainland China southbound funds amounted to more than 20 billion. Okay, so to answer your question, I think the underperformance is not attributable to this single factor, which only happened in June, 1 month ago. And then since this happened, daily market turnover we don't see a sharp decline, a sharp drop in the daily turnover on the Hong Kong stock market. Okay, any hope for fortune REITs? I think wait until the REIT Connect lah. It may breathe life again to REITs in Hong Kong. Okay, so I think now we reached 2 o'clock. I regret that I cannot answer all questions. I noticed that there are more than 40 questions being asked in the chat room. Sorry, but please subscribe to join our WhatsApp group and get more, and also subscribe our YouTube channel and got more update market information on Hong Kong, China, and the US market from Phillip Securities Hong Kong. Thanks for your time today. Now get back to the anchor, the host.
Thank you, Louis. Thank you, everyone, for joining. So before we end the session, we do have a complimentary live prizes to be shared with all of you. So if all of you are interested, you may scan the QR code to learn more on how to redeem these complimentary live prizes in our application. So I'll stop here for a while. For anyone who is interested, please scan the QR code. All right, so moving on, for you to receive a promo code in your inbox, please scan the bottom right QR code and fill in the feedback form for us. So it's a first come, first served basis, so be sure to fill in your info accurately so we can share you your stock coupon promo code. You'll be receiving the promo code in your inbox within 5 working days after the event ends on 10 July 2026. So once again, thank you everyone for joining, and we hope to see you again. Take care and have a nice day.